Hello, my friends. Today is June 14th, and this is Markets Weekly. So, this past week was an action packed week in markets, basically how it's been every week in the Trump era, and looks like it's going to continue to be like this for the foreseeable future. So, today, let's talk about three things. First off, we got a whole bunch of data on inflation and employment the past week, and it's looking increasingly to me that the Fed is late to the rate cutting party. Secondly, of course, we have to talk about the topic du jour, war in the Middle East. So let's talk a little bit about how the conflict between Israel and Iran could impact markets. And lastly, let's talk a little bit about the dollar, which is really not looking too good. And also, we should have it's just a small update on the trade situation. So this week actually began, with a positive note as President Trump declared a deal with China on trade coming out of discussions from London. But really, reading the articles, I'm not really sure what happened. It really seemed like China was slow walking rare earth exports to the US, causing pain to US companies. Then Washington asked for a meeting, and now those rare earth exports are resuming. So, what this whole thing tells me is that in the US China trade war, China has a clear upper hand, whereas the US is the world's largest consumer, and normally the client has enormous amounts of leverage, and it will continue to have with negotiations, say, with Mexico or with the European Union, Japan, and so forth. But with China, China has a lock on global rare earth production and a much higher pain tolerance as well. So it seems like whenever President Xi wants, he can just turn the screws on by limiting rare earth exports. So it looks like the US-China trade war continues to go very poorly. All right, now let's turn to the data of the past week. So from the Fed's perspective, they've been, kind of really worried about inflation as part of their mandate. So for good reason. Of course, we just had a big inflationary surge the past few years. But now what they're concerned about is that there are all these big policy changes and they're kind of frozen in place. They're saying that we have changes in immigration policy, regulatory policy, fiscal policy, trade policy, and so forth. And they're not quite sure how to react. And also, they've been looking at surveys that suggests that consumer inflation expectations have been surging out of control, and that's making them concerned as well. So what they've been doing is standing pat and continuing to tell everyone that they're just going to stand pat and wait until the data decisively turns. The market, as of today, is just pricing in 2 cuts this year. So this past week, we got a bunch of inflation data, both hard data and data on inflation expectations. Now we got CPI, which to the surprise of the market, printed in much lower than expected at just 0.1% month over month. Looking at the CPI broadly, it seems like what's happening is that year over year, headline CPI is just about 2.5%, with core CPI printing a little bit under 3% year over year. Now, headline is lower than core because there's been deflation in energy. Of course, oil prices have gone down a lot until the past week. So, just looking at these numbers, it seems like inflation is really just a bit above the Fed's target. So it doesn't seem like that inflation is a problem anymore. Now, taking a step back, looking at just the trend of inflation, it's really clear that inflation is decisively trending downwards. Now, even in places like, say, shelter, rent that has been sticky is also gradually trending lower. Now, many people have been worried about how tariffs can impact inflation, and we've discussed how businesses look like they're going to generally going to pass some of it on to consumers. Well, that really is kind of showing up, but really is not that important, because when you're looking at the inflation indexes, the most of it is services inflation, because the US is a services-driven economy. The goods part of it is a smaller part. Now, it seems like there is some upward inflation in goods. Obviously, that's the stuff we import from China, but its goods inflation is being overwhelmed by disinflation in services. So as the labor market weakens, wages don't grow as quickly, and so that puts downward pressure on service inflation. And so Services disinflation is overwhelming goods inflation, and that's leading to an overall, I think, disinflationary trend according to the inflation indexes. But again, that's just CPI. The Fed doesn't look at CPI, it looks at PCE. Now, after CPI, we also got the PPI print. That's basically the amount of, that's a measure of prices paid by producers, say companies, and PPI also came in lower than expected. So when you have CPI and you have PPI, you can have a pretty good estimate as to what PCE will be. Now, based on the Fed's estimate, Cleveland Fed's estimate, PCE is going to print at a pretty tame level. Again, it looks like it's going to be about 2.5% year over year, just a little bit above the Fed's target. Now, as tariffs have kind of been walked back, it seems like it's also had a big impact on consumer inflation expectations. Now, we've all seen that University of Michigan survey where, say, Democrats have very, very high inflation expectations, approaching 10%, and Republicans have pretty low inflation expectations, approaching zero. But overall, though, it seems like, according to these Michigan inflation surveys, the median inflation expectation 1 year forward has been coming down. And when you look at inflation expectation surveys from the New York Fed, which is, I think, not as politically biased, it seems, it's also been coming down, still above 3%, but still trending lower. Now, looking at market-based measures of inflation expectations, so 1 year inflation swaps, it seems like inflation anticipated by the market for 1 year forward has also been coming down. It spiked a whole lot after Liberation Day, but as the tariffs have been walked back, inflation expectations have been coming down. So all in all, it seems like both realized inflation is trending lower and printing out lower than expected, and also inflation expectations have been coming down. So whereas the Fed has been very worried about these things, it seems like that should be moderating. Now, the Fed is a two-mandate bank. You got inflation, and you also have employment. Now, what's the employment picture look like? So we had a pretty good jobs print for last month, again, comfortably over 100,000 jobs created, but there are also some signs that there are cracks in the labor market. Every week we get the unemployment claims, and it looks like continuing unemployment claims is surging to multi-year highs. So still, it's not super high, but it is a very steady trend that suggests that the labor market is weakening. So continuing unemployment claims is basically the stock of people who are unemployed and continue to file unemployment claims. So that basically tells me that people who have lost their jobs are having trouble finding new jobs. And so over time, the pool of the unemployed people is rising. So again, it suggests weakness in the labor market. So all in all, with just 2 rate cuts priced into the market, and the Fed, of course, is expected to not do anything at their meeting the next week, it seems like they really are just going to commit to being a bit late. So I think eventually, though, when the data does more decisively turn, we could have more rate cuts than expected, and probably on a more expedited time frame. So I guess we'll find out more this coming week, as we also have an SEP dot plot, and hopefully in that dot plot, the Fed will acknowledge that things are deteriorating. Now, one more thing on this note is that as we think about the Fed, I think it's important to realize that next year we're going to have a new Fed chair, and President Trump is already talking about who he might appoint. Now, there's whispers, of course, in the market that President Trump is going to get an easy money guy, and so rates are going to go much lower next year. I have no idea. Remember, this also has to pass the Senate. So some possible candidates for Fed chair, of course, are Kevin Walsh, Governor Waller, and this past week, Secretary Bessent was also floated out as well. President Trump always likes drama. He likes to have this apprentice-style tournament system, so I have no idea who's actually going to be Fed chair. But, as we've talked about before, Kevin Walsh would be a mega hawk, consistently hawkish throughout his career, and oftentimes quite wrong on his policy views. Don't understand why President Trump keeps walking him out. Waller, of course, has been much better on policy the past cycle. By all accounts, he's a good guy. I've met him before, but seems to be lacking a bit on the Trump loyalty metric, right? He's not strongly part of MAGA, although recent communication is suggesting that he is trying to signal that he is sympathetic to MAGA. But let's see how that happens. And of course, Bessent, I'm not really sure why he would want to be Fed chair. It seems Treasury Secretary is a much more important job these days as the federal government becomes more and more powerful. Definitely has expertise in markets, being part of the Trump cabinet, probably has loyalty towards Trump as well. So not sure why he would want it, but it seems like if he did want it, it would be a good candidate. But anyway, these are all the people we're thinking about now. Could be someone that we don't even have in mind at the moment. So also something to keep in mind. If it's someone uber dovish, that hopefully, now the market usually is not super forward looking, but hopefully that will have some impact on the markets. All right, the second thing we have to talk about is the war in the Middle East. Now, kind of piggybacking on the thought that the market is not really forward looking, that really has been my experience. Now, a lot of people say that market is a discounting mechanism. It's already, looking at what happened, but that, in my experience, is just not true. So you can see this in many ways, right? Now think about COVID. That was kind of the big event of our time, but really it wasn't a black swan at all. You had this huge pandemic happening in China, going out of control. Everyone saw clips of it on Twitter. Then you have it coming, spreading to Italy and so forth. So totally foreseeable. And yet the market really didn't react until the very end. Or you can look at the Liberation Day tariffs, right? Now, President Trump had tariffs his first term, been talking about tariffs for 40 years, been telegraphing it over and over again in his campaign, saying, 10, 20% on the rest of the world, maybe 50% on China. And that's basically where we are today. And still the market, just didn't seem to get it. Now, that brings us to this war in the Middle East. This is actually widely telegraphed as well. So earlier in the week, so the president, just chilling in Camp David with his advisors talking about the Iran situation. Then, again, this is all public, on Monday, having a call with President Netanyahu. Again, then on Wednesday, just withdrawing embassy staff from Iraq. And then, of course, in a press conference saying that, something might happen in the Middle East. And then, boom, the war happens on Thursday evening. So the stuff was kind of all in your face. So again, the market is not forward looking. And honestly, in my life, all the great trades I've made have been in these situations where it's just kind of so obvious that what's coming. Now, in any case, this and I've been listening to all sorts of experts on this now, to the extent there are experts in geopolitics. Probably know more than I do. But anyway, I've listened to many of them from all sorts of perspectives, and it seems like the very clear consensus is that this was a very successful and well-executed attack on Iran. And Iran is, really in a bad situation, and there are no good options. So ostensibly, this is about, say, Israel going forward and trying to take out all the nuclear facilities in Iran so that they cannot have a nuclear weapon. Now, the White House initially claimed that they had, no involvement in this, but of course, subsequently, we all know that of course, they were involved. Of course, they knew about it, and even President Trump is posting on Truth Social, seemingly to express support or even take some credit for it, now that it's gone well. Now, the immediate reaction to this, of course, is a huge spike in oil prices. Now, interestingly, if you think back the past few months, we've had OPEC gradually increase the supply of oil, and we also have found out through reporting that this attack was originally planned for April. So it looks like this is something that has been in the works for some time, just as we have more geopolitical risk premium in oil prices, and so many big oil producers have been flooding the market. Now, the really smart oil guys are saying that, this oil price thing is going to fade because at the end of the day, there's just a lot of oil in the world. OPEC is pumping a lot. And also, it seems like China has enormous amount of oil reserves that they can just release or use if they want. So from a supply and demand perspective, there really is no point in having really high oil prices. All this is geopolitical premium. Now, the people who are really gets worried about this could say that, maybe Iran can close the Straits of Hormuz. That would really impact global shipping. Maybe they can go and just destroy oil production facilities throughout the Gulf region. Maybe their own oil production facilities get destroyed and so forth. But that all seems to be kind of a low probability scenario, since if they were to do that, that would make their allies very upset, and that would also invite the United States to participate, which of course they don't want. So right now it seems like this is going to go on for some time. Prime Minister Netanyahu has suggested could go on for weeks. They're just going to keep doing this until they accomplish the destruction of Iranian nuclear facilities. So it seems like they have decapitated the air defenses over Iran, so they can just keep flying bombing missions until they get what they want. Now, Iranian facilities are buried deep within the ground, and normally people would not expect this to be successful without U.S. aid, because you need a lot of refueling. Iran and Israel are actually quite far apart, and also much bigger bunker buster bombs that the U.S. has, and you usually need big planes like B-2 bombers to carry. But it seems like Israel is able to accomplish this just by flying sorties over and over again. So that seems to be what's happening, and of course Iran is flying missiles and counterattacking. It looks like this is not something that's going to end soon, and there are no good options for Iran. Seems like also that what's happening is that there are mentions of regime change. That could be a potential goal. I feel like that story has been told over and over again and has never ended well, though. So this is something that's going to weigh on markets probably for the foreseeable future. Now, one thing to keep in mind is that we have quarterly options expiry this Friday, and also, of course, the huge GPM trade on the end of the month. So that's a lot of gamma that will keep the market supported. But in any case, something to definitely keep in mind. And usually, historically speaking, that geopolitical events are something that people would fade. But of course, you have to know when to fade it, because you fade it too early, it could get much, much worse before it gets better. All right, now the last thing that I want to talk about is the US dollar. Now, what's been really striking to me is that the US dollar has not been getting a big safe haven bid from geopolitics. And you can say similarly to the Treasury market as well. Now, a lot of things drive the dollar. You have rate differentials as well. And the past week, we did have a softer than expected inflation print, and that's leading the market to maybe price in a little bit more rate cuts, and that could be weighing on the dollar as well. But if you look at this DXY chart, it looks like the dollar really is deteriorating. And this is something that I've been writing about for a few months, actually. And I think this is going to be the core macro trend, I think, for the next couple of years. And understanding this and how this feeds into the financial system is going to be key to understanding asset prices. And of course, I've written extensively about that as well. Now, one thing I thought was really interesting is this chart from Bloomberg showing CDS, net sovereign CDSs, and how the U.S. compares to other nations. Now, CDS is just insurance people pay to insure against default from sovereign debt or debt in general. Now, sovereign CDS is usually somewhat nonsensical, because obviously the United States is going to pay its bills. Honestly, any fiat country really is not going to default. So this is going to be a very small market, very niche market, and it's not going to be super meaningful. But I think it's interesting, though, to at least compare what CDS pricing is for the US compared to other countries. And what this chart from Bloomberg is showing is that since Liberation Day, the US CDS has risen and is now trading comparable to countries, say, like Greece and Italy. So countries that are, not developing countries, but also not what you would expect from a reserve currency, top tier first world country. And I think that it reflects the broader theme that we see in a weakening dollar, foreigner rebalancing out of treasuries, and just the overall governance of the United States. So things are changing. The future will not look like the past. And I think this EMification of the US is going to be a trend that's going to continue for the foreseeable future. So I would expect the dollar to continue to weaken, and that is going to cause problems for all sorts of US assets, from treasuries to equities. And of course, it's also getting a big boost from, say, neutral assets like gold, which just continues to surge. And from latest data suggests it's actually the second largest reserve asset held by central banks right now, even more than the euro. So that's an interesting trend. And to my subscribers, if you look at my Markets View portfolio, gold has been my top trade the entire year, and it continues to do quite well. All right, so that's all I've prepared for this week, and I will be back in the middle of next week after the FOMC to offer my thoughts. All right, talk to you all then.